it's a great time to be in Indian equities, and I just thought, I'll start off with how our journey has been over the past 25 years, right? So as you can see, we started off from very small scale, and over these 25 years, we have been able to generate 15% CAGR over the last 25 years consistently, scaling up new highs. And this has been backed by very strong earnings growth trend over the last 25 years as well. And then on the next slide, if you see, you have the mid cap and the small cap index returns plotted for the last 20 years. And these index on the mid cap and small cap have in fact performed better than the underlying Nifty index, giving high teens kind of return over these past 20 years or so. This is just a sectoral breakup, how we have given how these indices have fared over the last 17 months. So as you can see, and I mean, these are updated as of May, but broadly the chronological order remains the same in terms of hierarchy of return. So reality, even up till July, remains the best performing sector over the last 19-20 months or so. Giving close to 130 plus kind of returns for. And if you see, I mean, in the reality sector, there are sustainable reasons why this growth trend is there and would likely to continue. So we saw the sector going through a big downturn in the past decade or so, where you saw balance sheet issues with individual companies. From a financing side, you saw banking sector reeling under stress. And all of those issues were solved with a lot of policy reforms in the form of RERA. And then the whole balance sheet unwinding, which happened at both the bank level as well as the corporate level. And we now see a much leaner balance sheet for these reality companies, which is driving the entire growth story. And I'll talk more about this in the coming slides. The next best sector is obviously autos. Now, this is a sector which has seen in the past 5 years a lot of disruptions, I would say, in terms of whether it be electric vehicles, whether it be the whole technological angle included in the auto sector, or whether it be the BS6 emission norms. The sector is going through a lot of changes and will undergo a lot of changes, but some of these companies are coming out to be better. The next best is obviously infra, and this is primarily being driven by a lot of government capex, both center and the state. And you see again with leaner corporate balance sheets, a lot of these companies bringing about good amount of growth with the help of government expenditure. On the next slide, we have shown corporate profits to GDP. So if you see the red bar, that indicates the listed companies' corporate profitability. And if you see the black bar, that is represented by the unlisted universe corporate profitability. And why this is important is because if the country has to grow, or even if the markets have to grow, your corporate profits need to continuously scale up, because as we know, the market can give you only so much returns as your underlying companies can grow, right? So if your companies grow 15% CAGR over a very long period term, even the markets tend to give you similar returns as well. So you see the corporate profit to GDP inching up over the last 3 or 4 years post-COVID. And we believe this trend is probably going to continue. Mind you, this is on a very enlarged base of GDP versus what we had a decade ago. On the next slide, what we have is the Nifty earnings plotted across time over the last 25 years again. And as you can see, the earnings has gone through uh, three phases, I would say. Probably the initial phase, the early 2000s, was the growth phase, where we saw Nifty growing in low teens kind of number. And then probably what I would call it a lost decade, where we saw merely mid single digit to high single digit kind of earnings growth coming in for the Nifty. And now, post all the reforms which the government has taken, and with a lot of cash available with the corporate guys, you see again the earnings CAGR for a lot of these Nifty companies coming up. So overall, if we see in the past 2 decades, Nifty has delivered close to 14% return, and the earnings have closely tracked them at 11%. Why we are excited still about Indian equities is we believe in the next 2 years, from FY24 to 26, earnings should broadly continue to grow at 15% healthy CAGR. While 2025 might be slightly slow given the base, the earnings will catch up in FY26. And again, I mean, I get a lot of questions on, you know, where are we in the cycle? Is this the kind of peak earnings we are going to see? And probably if you see, the magnifying glass over there from FY03 to FY08, in those particular 5 years, we have grown at an earnings CAGR of almost 24%. And the Nifty CAGR returns at that point of time were close to 30 plus percent. This is very important to keep in mind, because when we undergo such a bull run phase in earnings, we typically get overwhelmed by, earnings in high teens can't grow further. But as we have seen, if you have the right ingredients in place, you can typically continue to grow way stronger. This is just a snapshot of how Nifty valuations look versus over the last 10 years, right? And if you see broadly, the Nifty PE is, I mean, this is as on June 30th, July 30th, it's slightly above the long term averages, but it's broadly tracking those numbers. What is important to see is the right hand chart, which is the Nifty 50 ROE. As we always say, your valuations will be dictated by basically two things: A, the earnings growth, and B, the incremental ROE. As you can see, the earnings growth remained pretty strong at 15% is what we expect. And then the ROE number is almost at multi-year highs at 16.3%. And that, I think, so far and so forth, we have these two things in place. I would believe that these premium valuations for the company should continue. This is just a snapshot of how things look at the mid cap and the small cap level. So as you can see, obviously the valuations compared to the averages are expensive. Both of them are one standard deviation above the averages. However, we strongly believe there is a strong reason why these mid cap and small cap valuations are justified. And this slide rightly, encompasses that reason. Now, these are very strong growth numbers. And again, if you see the ROE, in both the areas, we see ROEs inching up continuously, which drives me to my earlier point on, if the growth trajectory continues and your return on equity continues to do well, you will ideally see these premium valuations on the mid cap and the small cap index absolutely being justified. Another way of looking at this particular picture probably is looking at the PEG ratio, as we call it, which is nothing but the price equity growth ratio. What we tend to do over there is nothing but take the PE ratio and divide that by the growth number. And if the ratio is roughly around 1 times, 1.5 times, that is a healthy number and the valuations we see is justified. So just giving you an example, for the small cap index, we saw the index at PEs of 21, 22, and we see the earnings growth, estimated earnings growth at 28%. So if you divide the 21, 22% by 28%, roughly you get a PEG number of less than 1, which still means if this high growth will sustain in the future, we do believe the Nifty mid cap and small cap index to continue keep doing well over the coming years. This is just another cut to show you why we are pretty positive on the mid cap and the small cap index. You may have these occasional downturns in the mid cap and small cap, given they are volatile and given the valuations do look expensive. But over the longer term period, we continue to be positive on the mid cap and small cap index. And this is just another slide to basically show you that. So if you see over here, the bottom four industries, right, on the cap goods, the chemicals, reality, and the consumer services are really not represented by the large cap index. You have almost 30% of your total index weight being these four sectors, which really cannot be represented by the large cap index. So what we truly believe is that the mid cap and small cap index is the true representation of how we should see an economy, right? And this slide would probably summarize the entire thesis, what I'm trying to say. So if you see, these are the newer IPOs which have come over the past couple of years, and I've just plotted kind of the various sectors or the various industries or businesses these particular IPO companies form part of. And the breadth is really nice, right? So you have newer auto dealers coming in, and there is not just one company now. There are like 2 or 3 companies in this particular space. You have a luxury furniture manufacturer, you have an air drone manufacturer, courier services, airport management services, so on and so forth. And what we believe, for a 140 crore population like us, this mid cap and small cap breadth is the true representation of a 140 crore kind of population economy. And it's not just the financial services, it's not just the FMCGs of the kind. It's this true breadth that you really want to have in your portfolio if you really want to gain advantage of the entire India growth story, so to say. Next, probably I'll discuss on what are the 3-4 themes we are pretty upbeat on, and what has really even worked for the market as well over these years, and we believe this is likely to continue. So the first one is infrastructure and reality. We have power as an obvious sector which comes to our mind because of the huge government focus to really bring down this peak power deficit demand and keep bringing out lower. And there has been a lot of capex, be it on the generation side, both renewables and non-renewables, or on the distribution or the transmission side. We have seen increased stress of the government to improve the infrastructure in terms of be it roads, railways, telecom, metros, so on and so forth. And you see real estate, as I mentioned below, a big kicker in the overall scheme of things with a much leaner balance sheet. And what that tends to do is have the underlying sectors in the real estate also do well. So you see a lot of building material stocks and companies doing well as well because of the same reason. The next key pillar for us is manufacturing. And we believe this is primarily being driven a lot by the government incentives and the reforms which they have brought about in the last decade. And we believe this is likely to continue if India has to really achieve the Viksit Bharat dream by 2047. So you see within the EMS space, the kind of PLIs we are seeing, you see the expenditure in railways, be it better technology integration within the railways, or be it newer coaches. Uh, Defense is a story in itself. We were one of the largest importers in the defense space a decade back, and today we are exporting in defense. That is a story in itself. So PLIs, ease of doing business, focus on exports is the thing which is driving these particular segments, and we'll talk about it in detail. The third one is consumption. Uh, we believe will be a very strong theme as India progresses ahead, and as the disposable income and the per capita income moves from the 2,500 odd dollars and scales up further. And there are various reasons why we believe premiumization being a very important one. We have already seen a lot of stuff on formalization of economy. This has already played out a lot, but the other bullets on urbanization, I think so. This is going to be extremely critical. Uh, China had an urbanization rate of less than 20% in 1980. Today, it is at 65%. We are roughly in the mid 30s when it comes to urbanization rate. And if this urbanization rate improves, it automatically leads to your per capita income and your disposable income and the entire consumption story kicking in. Um, and the final, pillar is on financialization. And obviously, you see a lot of interest over here with a lot of financial inclusion, financial literacy, investments into equities, people becoming much aware and moving away from the traditional assets which they used to invest in. So we'll discuss each of these pillars in some bit. Um, so on infrastructure, if you see the left-hand chart gives you the gross fixed capital formation as a percentage of GDP. And if you see, this has kind of moved up from the 2021 levels. And again, the question, if anyone has any questions with regard to, where we are in the cycle, have we seen the peak of the capex really happening? I think so. We can draw some analogy from FI05 to FI08. So if you see, we were at 28, 29 odd percent GFCF as a percentage of GDP, and we moved to almost 35%. We are still at 30 odd percent currently, and I still believe we are somewhere midway in the cycle, and there's still some way to go in terms of the entire infrastructure story. On the right side chart, you see how capital expenditure as a percentage of GDP is increasing, and this is primarily being driven by a lot of government capex, be it center or state. But we do expect the private capex to slowly start kicking in now with the balance sheet strength they have. This slide is an excellent slide to show how the different governments, both center and state, and the private capex cycle is kind of been over the past 15 years or so. And if you see, I mean, in the recent years, the bulk of the heavy lifting has been done by the central government, which is represented by the dark blue kind of bar, right? And the state government has recently kicked in with some of these states now having capex as an incremental lever for their growth as well. But we do believe the light blue chart is a light blue bar is something which is missing in the entire story on the private capex front. And I think so. This is one thing which you'll start hearing incrementally going forward as well. Um, this is just to show that despite this entire capex story, the government is extremely committed to the entire fiscal consolidation plan, with its commitment of FY25 target of 4.9% of GDP and less than 4.5% by FY26. The government is clearly going down the glide path which the FRBM has kind of laid down. This is just a representation in terms of different sectors, how the entire growth story we see panning out over the next 2 to 3 years. So you see power sector being one of the major drivers for the entire growth story, but even the other sectors, be it roads, railways, are kind of going to contribute. PLI is going to be one of the big levers for the entire growth story, obviously. When it comes to the entire scheme of things. I just thought I'll include this slide because sometimes, when you look at numbers, you really get lost as to what really is happening in India. And I think so this is a very good representation of how well we have moved over years. So on the right hand top exhibit, you have, for anyone staying in Mumbai, you pretty much know the coastal road and undersea kind of tunnel, which is built by one of the listed companies in India. And this is a marvel, and it has reduced travel time to a great extent. On the left hand side top uh, uh, exhibit, you have the Badla Solar Park, which is a joint venture between the state of Rajasthan and the Ministry of Renewable Energy. This is the world's largest solar park, which is covering close to 56 square kilometers, which is like 14,000 acres, right? To really maintain this kind of capacity at 2.2 gigawatts, solar, with all the storm weather conditions in Rajasthan. You can just imagine the maintenance which might be going into to really build about this kind of humongous infrastructure is really something to call out for. And the bottom one is really the Chenab railway bridge. Now, this from the center, if you kind of see, is bigger than the entire Eiffel Tower. And if anybody has kind of been to the Eiffel Tower, it's such a daunting kind of structure in front of you. This is much bigger than that. And on top of that, if you have a railway train going on this structure, and this is built by one of the recently listed companies in India. So just a word on real estate, as I mentioned. I mean, if you see the inventory levels, those have kind of consistently come down over the past 1 decade, and we saw a lot of issues in the real estate over the past decade, be it uncompleted structures, be it the debt position with the corporates, so on and so forth. And from there, we are now seeing slowly the unsold inventory kind of in the tier 1 cities. And this is true for the tier 2 cities as well, slowly inching down. And your launches, this is despite the launches being very healthy. The absorption rate for some of these real estate kind of projects have been really good. This has been complemented by obviously the affordability factor. So if you see the home loan as a payment to income has really come down with the interest rates coming down over the past decade. Yes, they have slightly inched up, but we might be probably at the top of the interest rate cycle, and we might see interest rates coming down. So you could again see your home affordability improving with higher per capita income as well. And then you have the housing loan book, showing the same output of these higher kind of demand. We move on to the next pillar, which is manufacturing, and we just thought this gives a perfect snapshot of what opportunity we are trying to look at. So if you see the exhibit on the left, we have the share of manufacturing in the GDP. So we are at $3.6 trillion. The current contribution is 610. So we are somewhere in the mid-teens kind of range, and the government expects this to move to almost 20%. So on a $7 trillion economy by 2030, we do expect the manufacturing output to go to $1.4 trillion. And this will be mainly driven, one of the key sectors to watch out will be obviously electronics. We are seeing it in the form of smartphones already playing out very well. But if you see the kind of growth rate, it's a $100 billion industry currently. The government expects it to grow to almost 5 times, to almost $500 billion, and which is where you'll see a lot of newer companies come in. Again, the building blocks are in place for such a strong, manufacturing story. So to say, we have already talked about the corporate profit to GDP. On the right side top chart, you have the capacity utilization levels, which are roughly at 74-75% at the entire industry level. However, if you see different industries within those 74-75%, you would have, for example, a capital goods industry, which is roughly at 80 plus kind of capacity utilization level versus maybe a cement, which is much lower. So, but on an average, if your capacity utilization is roughly at 73 plus kind of levels, what we see typically is the boom of a new private capex cycle. And that is the reason why we incrementally believe that we are just at probably the cusp of a strong private capex cycle as well, post the government cycle. On the left side corner, you have the corporate debt to GDP, and as I've been mentioning, this is at decadal lows, which we see at 0.7 times. You couldn't have a healthier balance sheet to kind of build up the entire, corporate capex cycle. And you have the financing companies as well, which have cleaned up their balance sheet with a lot of recapitalization from the government side. And you see the GNPAs at their all-time lows. Third important pillar, obviously, is consumption. And we need not stress the demographic advantage which we have in India, with a median population age currently at around 30, one of the fastest growing working age population, which is unmatched in the entire world, sitting at per capita income of 2,500 odd, and can scale up to more than $5,000 in the next 7-8 years or so. Again, urbanization is a very important story in the entire scheme of things, and nuclearization, people moving out of their joint family concept, living separately. You have seen this story from, be it luggage, where we used to share one suitcase across the entire family of 15 odd people versus each nuclear family now having 2 or 3 suitcases individually. So we believe with the internet penetration and all of the building blocks in place, again, this is consumption is something which is likely to play out shortly as well. On financialization, I mean, it's pretty obvious. One of the biggest stories in India over the past decade, how the equity investments have kind of increased. You have more than 20,000 crores of monthly SIPs currently, from a very low base. You have the active clients continuously increasing at 4 crore plus kind of number now. And, again, if anybody has doubts on, is it too much investment into equities, which has already happened? Let's see US, where they are placed, right? More than 50% of the entire household financial assets sit into, the equity and the equity related investments for US. We are just at 18-19% currently. So there is a big scope still. You still have 39% just sitting in bank deposits. This number again for US is just 14-15%, right? So you have a big lever in terms of the entire financialization story still to continue. And this is just a slide to show how the DIA domination is kind of increasing over the years. So if you see the right-hand side chart, you see the FII to DIA ratio slowly inching down, and it's at 1.3, a multi-year kind of lows. And we believe with this happening, incrementally, the impact, a big impact of the FII flows would tend to kind of come down. So what I thought is we are going to probably come out with a NFO shortly over the coming months, and we just thought we'll give you some color which will be based on the exports theme, and we just thought we'll give you a color on why we are so excited about this upcoming NFO. So this is a good slide to indicate our excitement. So if you see the government targets, these are all government targets. The nominal GDP currently is at close to $3.6 trillion, and the government expects it to move to 2030 to almost $7 trillion, which is almost a 2x kind of a number. However, your Indian exports target is from the current $783 billion to almost a $2 trillion kind of number, which is a 2.5x kind of growth. And products will grow equally at 2.2 times and services almost at 3 times. Now, what this tend to indicate that if your nominal GDP is at 2x and your exports are growing to go faster at 2.5x, effectively the companies within these export sectors would tend to grow much faster than your overall GDP growth. And, again, higher growth would tend to transpire into higher kind of ROEs typically, and those would lead to better share performance as well, which is why we believe this is going to be a great theme. On the next slide, I have given a picture of how the world exports look currently. This is both export of goods and export of services. And on the right-hand side chart, you have the table of the GDP number. So it's very important to understand why exports is going to be incrementally important for a country like India, right? So if you see the right-hand side table, China in 2003 was at number 6 position, and it scaled up in the next 10 years to a number 2 position. And one of the big levers for this entire GDP growth was the export story which the country has experienced. It is still the world's so-called export factory, with $3.5 trillion of exports in 2023. And if India has to transition now from its journey from number 5 position in 2023 to, kind of 3rd position in 2030, exports is going to be an extremely important story for that to play out. As you can see, the top countries over here are also the top exporting countries, if you see on the left-hand side chart. So I couldn't emphasize more why exports is going to be extremely important for an economy to grow. On this slide, I've basically given how the export growth story has played out for us from almost, over the last 25 years, from $62 billion to almost like $783 billion in 2024. We are currently at almost 22% as a percentage of GDP in terms of exports, and we expect this number to inch up to almost 28 odd percent if we have to achieve the target of a $2 trillion kind of exports. Again, this is just a breakup in terms of the services and the merchandise exports, how they have happened over the last 25 years or so. So if you see, obviously, services export has grown way faster than the merchandise exports, and which is why, there has been handholding by the government initially for the services in the form of software technology parks, SEZs, a lot of tax incentives initially to set up those services in the early 90s and early 2000s, and you are seeing the fruits now. And this is exactly the same thing which is happening now for manufacturing, where you see PLIs and a lot of these tax reforms, corporate taxation rates coming down, and you'll see the fruits over the coming years for the merchandise as well. Again, why exports theme in India? We believe there are four key factors to drive the entire exports kind of theme. The first is the leadership in the labor, be it on the cost side or the skilling side. India, with as I mentioned on the demographics, we have the highest working age population in India, English speaking population, and highly, with the right guidance, we can get the right skilling as well. The next bit is on government policies, reforms, and incentives. We have already seen a lot of stuff on ease of business, PLIs, and so on and so forth. On the third bit is the entire supply chain diversification and the China plus one theme, which is playing out with the whole entire geopolitics situation. You will start hearing newer terms like friendshoring, and you will start seeing nearshoring, where factories will be set up in friendlier countries, which will kind of boost India's advantage as well. And the fourth bit is on, we now have the entire bouquet of services or goods, right? So we were initially a very low end kind of manufacturer, be it gems and jewelry. So we were just kind of polishing stuff on the low end, be it, on the services. We were just a BPO driven service earlier in the early 1990s. And we have transitioned from there to a more high end auto ER&D, GCC capabilities kind of stuff, which I think so is going to continue as well. And this is just a representation to show you how the export growth story has played out, right? So this is on the smartphones, and so we were a net importer of smartphones in the year FY15, right? As you can see, the domestic production is represented by the red bar, and the domestic demand is represented by the black bar. So we were a net $9 billion importer in FY15, and in less than 10 years, we are today having excess capacities, and we are exporting $15 billion worth of smartphones, which was almost nil, say 5-6 years back, right? Which really shows you the power when your PLIs, the right government policies, the company actions in terms of capex combined, how that can have a parabolic effect.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.